All right, welcome everybody. It is Friday, April 3rd. If you're just joining us, we got a little technical difficulty, but these days that seems to be the normal. If you don't have a dog barking in the background of your Zoom session or on Facebook, or a cat coming up real close, or a baby crying in the background, you're probably not having a normal day in today's environment. So welcome to the show, This Week in Housing. I'm Tom Ferry, and I'm excited that you're checking in. The purpose of this show is to keep people informed on a national level, what's happening with residential real estate. So if you're watching this, and whether you're an agent or you're a consumer, that your agent sent this to you, by the way, that's a good thing. That means that agent's doing an excellent job keeping you and the community informed on what's happening right now in housing. Today, we're going to talk about mortgages, and we're talking about home loans. And we're going to talk about the impact of some of the things that are happening right now in our country. So I thought it would be important to bring in some experts. So I've asked Steve Harney, who is the founder of Keeping Current Matters, and his partner, David Childers. Between the two of them, probably 45, 60 years, I'm trying to add it up in my head here, both residential real estate brokerage as well as mortgage and finance. It is arguably one of the big questions right now. We're going to talk about forbearance. We're going to talk about what's happening with loans. Are they working? Are they not working? So first of all, guys, I know we ran a little bit late there. Thank you for dealing with our little technical difficulty, and thanks for joining us on the show. So good afternoon.
You're so much a better person than I am, Tom, because I would have blamed it on Zoom or somebody. I would have said, oh, they must be overloaded on their platform. You're so much nicer than I am.
Well, there's a pretty good chance that they're doing it, but I think we're all going. Today's new norm is you might have some technical difficulties. So,
right.
David,
Okay.
welcome, David, also welcome to the show.
Hey, thank you, and I agree with you. I'm sitting here in my house, but all of those things are happening every day.
Absolutely. So, we want to keep this short and impactful for the viewers today. So again, I want to thank you guys in advance for taking the time out of your busy schedules. I know you're doing hundreds of these, all over the place right now. So let's get right into it. Last week, we had talked about the changes in FHA and FICO scores, non-QM mortgages, as well as jumbo mortgages. Can you guys just maybe start with just any updates from FHA or non-QM that we need to know about today?
Sure. But before we get started, Tom, I just want everyone on the call to know, mortgage people, and that's what David is for many, many years. He was the vice president or one of the leaders of one of those four big banks. And they talk mortgagees. And so he's going to be talking in mortgagees. We talk in realtor-ese. And they're kind of it's very similar language. But I would suggest I suggested to David, if today he could just speak in regular English, so that the people can not only can understand what we're saying, but also be able to share it easily with their consumer. All right, because we do sometimes get caught up in our own, LTV and what they kind of margin call, and everyone's going, why? What is he talking about? So we're going to try to really simplify it so that I can understand it. Okay.
Perfect. Thank you, Steve.
Yeah, absolutely. And Steve and I talked about this, Tom. You and I were talking right before this call. And let's talk about the three products we talked about. When we talk about products or loans, the first being non-QM. And think of that as non-traditional financing. These are loans that fit outside of the traditional channel of what mortgage loans are, maybe self-employed borrowers, folks that may have a unique financial situation. And they are right now, as we speak, they are on the sidelines. They are not available. I can't say how long, but I do know one thing we do know about the past is this market comes back. And each time after a crisis or after something that's happened, it's come back. And so right now, unless your lender has a solution for you in this area, I would say that isn't an option. And Steve and I were talking before, one of the things that I would encourage anybody on this call, whether you're a top producing agent or a consumer watching this, is talk to your lender, because they may say, I have an option there. But what we see across the country is that non-traditional loan, that what's called a non-QM loan in our business, is gone for right now.
All right, and for the realtors out there that are listening, and maybe for the consumers, non-QM, what does that really mean? basically, ladies and gentlemen, what happened is 2008, we were given a lot of loans to people that shouldn't have gotten a loan. All right. And then right after the housing crash, everything got really, really, really tight. So there was actually times during 2010, 2011, that really good people with good jobs, which just didn't fit the tight criteria that came into place. And what some investors said, you know what, we'll go ahead and finance those loans. And they started with, you have to put 25% down so that they're protected. Then they said, the housing market's doing pretty good. You only have to put down 20%. You know what, the housing market's going so good, let's do yours with 15%. It just kept on getting more and more that it wasn't a special type of loan. And so what wound up taking place, they were doing those loans. As soon as things got a little bit nervous over the last couple of weeks about what was happening, those investors just decided, you know what, now's not the time for me to be in that business. And it seemed like they all pulled out together. I was talking to a loan officer on Monday. I'm actually a person who handles a pretty big mortgage entity. And what he said to me, oh no, we still have that. And I said, well, really? Because that's not what I'm hearing. I said, 30 days ago, how many places did you have? How many investors did you have to go and give that loan to that would fund that loan so somebody could buy a house? He said, well, about 21. I said, how many do you have today? He said, 3. I said, how many do you think you're going to have tomorrow? He goes, one's already shaky. So what's happening is they're disappearing slowly, so that you might have a loan officer that might have some money, but he might not even have it tomorrow. Okay, so I want people to understand that whole element is kind of disappearing. And I didn't mean to take it away from you, David. Go ahead.
No. And that's such a big point. So let's talk FHA for a minute. So these are, when you think about an FHA loan, a lower loan amount, lower down payment, and there's been a lot of talk about credit scores and the requirements for FHA loan. And so I want to address that and say that here's what's happening right now. Lenders are changing their credit score requirements for FHA because of the risk they see, the risk of default, meaning somebody would not make their payment. In the industry, what this is referred to as risk-based pricing. So the lower your credit score goes down, the more it's going to cost. So I'll give you an example. Steve and I were on with a lender last night until, 9:30 or 10 o'clock, a large mortgage company owner, and they were saying people in their market were looking at FHA loans at lower credit scores, meaning the low 600s, but it would cost 16 points to originate the loan. So if you think about 16 points on a $100,000 loan, that would be $16,000. So if somebody says, yeah, I can do that. For $16,000, you can do that all day long. So the reality, and even today, I talked with another lender this afternoon, they're seeing lenders that will not take that. They're not offering that. So higher credit score requirements because of the chance for risk. And so right now, I think if you have an FHA loan, if you're in process in buying a home, or if you're a realtor and you have somebody you're working with who's in process, talk to your loan officer about what are the credit requirements. And you may need to go back in and pre-qualify again, or talk about what do we need to do? What do we need to change? What, based on my scenario, may change because of that. So that's FHA.
And I made a mistake last week, Tom. I said that the FICO score went from 580 to 680. And really, the FHA has not changed their credit score. It's still 580, but there's no mortgage entities that are willing to do a loan at 580 anymore. Yeah. So they overlaid their requirements on top of the FHA and said, you have to go to 680. And again, as David said, you might be able to get a loan a little bit less expensive than that. But, in regard, you might be able to get a loan with a lesser FICO score than that, but you're going to, pay up for that. Now, the particular home buyer on a particular house, they might be willing to do it, but it seems to be a little bit, I want them to understand that they're going to have to pay up if, they don't have the right credit.
Yeah.
So gentlemen, I just want to interrupt for a second.
Sure.
For all my listeners out there that are with us live, we're talking with David Childers and Steve Harney from Keeping Current Matters. We're talking about mortgages. We're in the update conversation from last week. Today, we're going to be talking about also some insights on jumbo loans. And we're going to talk about forbearance, right? Two sort of pressing issues right now for a lot of agents and consumers. The one thing I'm going to stress to all my agent friends that are watching this is, if you're working with a buyer today and they've got a lender that they love, it's important that we're helping. It's important that you're reaching out and making sure that you've got additional resources, because the frightening thing is you get down to the wire and suddenly you're told, oh, we're not doing that loan anymore, right? So this is really about making sure people are well taken care of and informed. And I know as a part of my community, we've been talking about this now for over a week. So just want to reiterate that point. So David and Steve, I want to talk about jumbo for a second, because last week we basically said, hey, FHA is changing, FICO scores are changing, non-QM is going away, and jumbo mortgages. So bring us up to speed on what's going on with the jumbo market right now.
Sure. So let's talk jumbo mortgages just for a minute. Let's talk in some general terms. That means different things across the country and in different markets. You take a market like I'm in here, Tom, in Virginia, that may be $500,000 and above. Take a market where you're at, Tom, in Southern California, that may be $750,000 and above. So depending on your market, it means a little bit different thing, but I'll say this, a large percentage of lenders that offer jumbo mortgages across the country are pulling back in that category. There are still jumbos out there, but there are a lot less. Steve gave an example earlier. There are a lot less today than where we were 30 days ago. And it's safe to say they're getting stricter and stricter at what they'll even look at. So let's talk just a minute about what if you have a jumbo deal in the market right now, because I think that's something worth kind of going deeper on. My coaching, and Tom, you're so good with the words here, is first go to your lender and ask this: what is your plan for jumbos? What is your plan? And listen to what they have to say, because they may say, we're cooking right along. It's going to vary from lender to lender, but find out what their plan is. You may end up in a situation where somebody says, we don't have access to that capital. So let's talk just a little bit about, if you find yourself in that situation, what you can do. So the first thing you can do is get creative. We talked about this last week, looking at high balance loans. Maybe if you're buying a home in a jumbo category, putting a little bit more money down so that you get your loan below that threshold. You can also look with your lender for what's called, in the business, subordinate financing, or taking on a second, maybe usually with a smaller community bank, in being able to do that. So there are things you can do when you get creative. You also, if you have a client that's a high net worth client, you'll want to have a conversation, or they'll want to have a conversation with their bank. And I'll say this, their asset profile will oftentimes in this market help them obtain that financing, where the bank is more motivated to lend that money to them.
All right. So wait a second. We went back into the mortgagees talk right here.
Yes. Yeah.
All right. So let's get their asset profile. What David's saying, if they have $1 million in the bank, they have $500,000 in the bank, they can go to their bank and say, I need a mortgage, and they're probably going to get it, because they don't want you to move the $1 million over to some other bank. So the asset portfolio is your cash that the bank is holding on to. And if you have a situation where you have a relationship with a bank in any big numbers, they probably will do something for you, but they wouldn't do something from someone coming from the outside that they don't know.
Yeah.
Steve, would you shed some light from your experience on, because David really used some of the stuff that I would say from a language standpoint, any other insights on sort of creative approaches for these jumbo transactions, these, higher end transactions?
Well, I think that David's going to do one more. I'll go now. That I want David. You were talking to me last night, and the gentleman we were talking to, who was probably the best guy in the business, he was giving us an option with like a second mortgage, but I'm not going to get into that. I'm going to let you cover that, David.
Sure.
What I would be doing is, I really do believe that, the adage that we use here all the time, tell the truth and trust their intelligence. So it depends on the deal. If a buyer really, really wants to buy that house, can he come up with the extra cash to bring the jumbo mortgage into a regular mortgage? All right. Or if the seller really, really wants to sell and they got the right buyer, are they willing to do some sort of adjustment there in order to get the deal done so they can get into a mortgage they can do. All right. And probably, if it's a deal they both want, you might be able to get some negotiation on both ends of it. So that's your ability. I know you do great negotiating class. I think you did one on Tuesday. That's your ability to negotiate. If in the first thing to a negotiation is really understanding what the person on the other side of the table, in this case, the other side of the screen, the person on the screen, what do they really want? If you can get down to really what they want, then you're in a position to say, if that's that important to you, what are you willing to pay for that? Well, what I really want is my kids to grow up in this school district. What I really want is to be able to look out on the ocean like Tom Ferry every night. Whatever it is that they want, if that's a strong need, they'll pay more for that. And if the seller has a need where I have to get out of here, I just don't want to be here anymore. Newly divorced and my wife lives next door with her new husband. I need to go. If that's the case, then maybe they'll be willing to negotiate some. So again, you have great agents, and I'm not talking about holding anything over anybody's head. I'm not saying that at all. I'm saying really truly understand the needs of both the buyer and seller, and sit down with them and have a truly honest conversation. Listen, it's a shame this happened, and it's a shame it happened right now, but it did. And now we have to go on from there. All right. And I think a lot of people understand the world's kind of changing right now. So they'll give you the sellers out there. If there's any sellers or buyers out there, if I'm talking to any consumers directly, just be a little patient here, because the whole world is kind of a different place than it was 21 days ago, and everyone's trying to figure that out.
Yeah.
All right. So that's the advice I would give there. Now, David, you have a little bit more creative way that they might be able to do something.
Well, I think going back to that, Steve, you listed out a lot. And I said, we started this out to go to a lender and say, what's your plan? If I'm looking at that, I'm going, okay, how do I exhaust my resources? And we talked about high balance, like, can we put more money down to get below the threshold and access a loan product? We can talk to someone about, is there a small community bank that will take on a second, in this case, subordinate financing? Or thirdly, do I have a banking relationship that will allow me the opportunity to get financing? Let me give you an example of that. And I'll use a specific bank, Bank of America and Merrill Lynch. Merrill Lynch is owned by Bank of America. You're high net worth or you have a Merrill Lynch account, that's a conduit to go in. That's certainly one. There are many, many others of those. But my advice right there would be, what is my strategy to exhaust my options to move forward here? I think that's what this market needs. It's what all of us are going to be looking for. It's what great agents are going to do. And it's what we need to, be able to kind of attack this problem with.
And another thing I'll add to that too, is another strategy is who filled that void somewhat in the 2010, when it was like, all right, we're not doing any more of that. There's no more, the situation. Sometimes there's a local bank that might be like saying, all right, fine, we have some deposits that we might be able to invest in a local piece of property that someone's purchasing, and they might have whatever they have in assets, and you might be able to tap into that from a local source and maybe be able to do some loans through that process also, because that's something. Now, I will just warn, the agents on this call, to warn the consumer, the speed at which those banks work is a lot different. So they're going to ask for every single piece of pay, and you're going to have to do it 14 times. So if you can find a relationship with like that, then you want to just educate the consumer is like, this is a little bit different and it's going to take a little bit longer. But again, the bottom line is, how important is it for you to buy that house? How important is it for you to sell that house? And that will have a determining factor on that.
Yeah.
Excellent. All right, guys, let's talk about the big one right now, especially with the stimulus package, the CARES Act now. Forbearance is on the minds of a lot of people. And I know you guys have some opinions and insights here. So I'd like to hear from you both, and I certainly will share mine as well. So David, help us understand it and maybe some of the mistakes to avoid.
Yeah, absolutely. So Tom, you and I were talking before this. I want to talk just a minute about something people may be hearing in our business right now about servicing and how it relates to that. And then let's talk about forbearance. So servicing. What is servicing? It's literally when we write the check each month or you pay your mortgage each month, that goes to the servicer. In our business, the servicer is different from the investor, two separate entities. Can be the same, but oftentimes two separate. Forbearance, this has been talked about, means we're going to...
Hold on. I have to bring that to English.
Yeah.
From your mortgagees again.
Okay.
All right. Let's assume that you were collecting rents for an investor and you would go to 10 doors every month and knock on the door. And when you got the rents, all right, you would then bring the rents to the investor and they would give you a percentage of the rents for going to collect the rents. That's the servicer. They're the ones collecting the rents, collecting actually the mortgage payments. They're taking a piece and passing it on to the investor. So that's what the servicer is. The person, the investor doesn't want to worry about calling you if you're 15 days late. They don't want to worry about taking the checks in. They don't want to worry about any of that. So they pay someone a small piece of the deal in order for them to handle it. Sorry, David.
No, you're absolutely right. So the simplified way that Steve explained that shows you the challenge with servicers. When someone goes into forbearance and doesn't make that payment, it puts tremendous stress on the servicer because they still owe the payment to the investor. Okay,
All right, so in that scenario, using my example, the deal that the guy collecting the rent, the person collecting the rent made with the investor, I'll take a little extra money, but don't worry about it. I guarantee you I'll always pay you the full 10 houses worth of rent. Now, all of a sudden, some of those houses don't pay the rent. That person collecting the rent has already made an agreement with the investor. I'm going to pay you in full, but they're not getting the full payments. And now what do I do?
Right. Yeah. So let's talk about forbearance. So we understand kind of the servicing aspect of it and what people are talking about right now. The first thing I would say is don't confuse forbearance with forgiveness, because you or your clients, if you're on here as a realtor, will have to pay it back. And the program really needs to be for those that truly need it. And I cannot stress that enough, Tom. If somebody's working, they need to make their payments for the good of the country and really the good of the housing market. And I would highly encourage you to do that. So let's unpack forbearance just shortly, and then I'll let you guys weigh in on this. The CARES Act, which was just signed into law, dictates that federally backed mortgage can receive as many as 12 months of forbearance and will be paid back based on how the lender specifies. Now, there are things happening in the market where FHA is going to say this is how this is paid back, but this can be paid back in a couple of different ways. It can be in traditional forbearance. You think about that. If you had $1,000 mortgage payment each month and you went through 3 months, you'd owe that 4 months of back mortgage payments on the 4th month. So certainly that would be challenging for people. Another way that it'll be taken care of is think about it as a second mortgage that sits on the back of your mortgage. And when you go to sell the house, you go to refinance the house, you pay that off. So that money does not go away. Or the third option that's certainly in this is similar to if you have escrows attached to your mortgage. You know how sometimes that will adjust on year over year based on a shortage or an overage in that escrow account, and your mortgage payment goes up $5 or $10 or a small amount. They could tack on a portion to your payment to satisfy that debt over time. So this is
that's not the choice, David. I maybe I'm wrong about this. That's not the choice of the person who has taken the loan. That's the choice of the person who gave the loan.
Correct.
All right. So I don't want you thinking that you have 3 options and you have to pick one. The option you get is going to be given to you. You're not going to be able to pick which one.
Yeah, absolutely. And so that's why we have to, get the word out there. But if you're listening to this, truly reserve that for folks that need it. People that need it should take advantage of it. It's why it's there. But if we're thinking, hey, this is an opportunity to skip 3 months or a portion of time of my mortgage payments, it is not for that.
I want to stress, and I know this is, I think it's very important that people understand we are in a very, very delicate situation right now. There are men and women in every community of every person watching this now or live or in the future that know someone that can't work, lost their job, was suddenly, furloughed, or their hours were cut back. I believe this program was created for those people, right? But what we know is when you create something at this scale, that there's just going to be a lot of people that are going to take advantage of this. So guys, what happens if people take advantage of this? What is there any downside? Are people that actually going to need it not going to get it because someone else just wanted to not pay their mortgage for 3 months?
I think there's two. Oh, sorry. Go ahead.
Go ahead. The biggest challenge to our business is the impact on the servicers, the impact on the industry by that. And so that's why your words of, if you need it, take advantage of it. If you don't, continue to pay your mortgage payment. That is the most important thing to stress.
And let's talk about that, in layman's terms again. If the servicer, which is that guy going around paying the rent, if they can't pay the rent or pay the payments to the investor, and the investor's demanding it, they have to somehow come up with cash. We were on another phone call last night that the 3 owners of the servicing company each had to come up with $2 million of their own money just to keep their company open. All right. Now, if they hadn't kept their company open, all those people would be laid off. So anyone who needs this money, I want you to get it. If you need this money, that's what it's there for. But I don't know if you're going to say there's a limited amount now, but what could happen if we have to go back to the well and get more money, there might not be any more money left in the well. So what we need to do is make sure that on this stimulus package, or whatever you want to call it, that on this particular one, that money is used wisely. And pretty much the government has said, we're going to make sure, we're going to leave it up to you. Just be honest with us.
Right.
So what we need to do is stress in the community how important that is. It's not like nobody gets affected if you're taking the money.
So fellas, I want to be clear, if the servicers, if they have a problem, how does that impact the homeowners? How does that impact potentially the real estate industry? I mean, beyond just the job loss, is there any deeper, bigger ramifications?
Well, I think that's certainly the question for our industry. And there are a lot of questions out there. Is there going to be relief for servicers? Are things going to happen to them? And as we go through this, I think that's the question that our industry will ultimately answer.
Well,
but what we know,
another way to look at that, and I think Dave is 100% right. Services are praying that they get some sort of help, because the government said, "Oh, you don't have to worry about making your payment for 6 months." And the service is going, "That's cool, but I'm the guy collecting the rent." Mm-hmm. All right. But I think that what we have to take a look at there is many services are also connected with a mortgage company. So like the people we were talking to yesterday, they had $6 million put in just to cover that they're okay as a servicer. They could have been investors on $6 million worth of jumbo loans with that same money. So because they're putting the money here, they don't have it to put it someplace else. Because as a mortgage company, if there was a decent person that came in and they've done business with that company before, and they're saying, "Well, I need a jumbo mortgage," well, we don't do them anymore. It'd almost be like the big bank that we're talking about. If you have a lot of money in there, if you have a relationship with that mortgage lender, they might say, "Hey, you know what? We could get some investors together to help you with that." But if the investor money is going into just keeping the company running because nobody's paying their mortgage, that's one of the reasons that the jumbo, the non-Q stuff is drying up.
Mm-hmm.
Yep, fellas, I have 2 questions that I'm just seeing here live on Facebook. One is, if we have forbearance, does it impact our credit score? That's the first one. And then secondly, one of our great business coaches, Larry Webb, asked, what about impound accounts like taxes and insurance? How does it work if you're paying that along with your mortgage? If you have forbearance there, what happens to that? So 2 different questions there.
Yeah, my understanding on guidance on the first question is that one of the reasons for forbearance is that it would not impact credit. Okay, so I think that was the first question: is would it impact credit? That's
right, so
the hope of forbearance.
Let's bring that to English.
Yeah,
guidance means what they're saying right now, but might not necessarily be the case at the end.
Yeah.
All right, is that they are hoping that it won't affect credit, and they're trying to make that happen. We don't know that that's definitely going to happen or not, but that's what they're pushing for. Sorry, David.
Yeah.
Yeah.
I feel like
The
the translator with the thing on my ear. It's saying, all right, now I got to do a different language.
The second question about escrows or impound accounts and how does that affect that? These things, Tom, that are coming up are questions that have to, through this, be figured out, because let's go back to the servicer. If it's not paid in, someone has to pay it. And so therein lies the challenge. And those are the things that are going to have to be figured out in this process. And that's why we're so passionate about using caution and being very clear that if you don't need it, don't tap it, because it opens up a lot of these questions and a lot of challenges that our industry is going to have to address and face.
Yeah.
And let's talk about the interconnection there, Tom, because that what you're talking about with taxes, the person asked the question, the insurance company's not good, it still has to get their money to put insurance. But let's take a look at your property taxes. Those municipalities probably right now, more than any other time, need to collect that money. There's all sorts of challenges they're dealing with in every single community. Imagine being in New York City right now and having the tax base dropping. Imagine being in New Orleans right now and having the tax base dropping. Now, the good news on the flip side of that, that's one of the reasons the housing industry is going to bring us back, because everyone is saying we have to build because that's what's going to bring the economy back. It's going to bring jobs. And all the local municipalities are saying, and we need the tax dollars right now. So there is some, an awareness that's taking place right now that how valuable the housing industry is to even local economies.
Absolutely. So guys, I know we wanted to keep this to 30 minutes, and I see a bunch more questions here. So I want to just touch on a couple of them. Some people are saying, no, it absolutely does not affect your credit. And I guess my advice to everybody is, you're always better off asking yourself, what's the worst case scenario? What is the most likely scenario? What is the best case scenario? And in times like this, right, especially for my clients out there, you hear me saying, let's assume the worst case scenario. Not that we want it, but then anything less than that, we can manage, we can deal with. Because if I can manage to the worst case scenario, everything else is a bonus. So I've seen the CARES Act. I was in conversations with my attorney, my CPA, my tax planner, multiple other business executives. And between Friday, Saturday, and Sunday, I had a lot of mixed messages. By the time I finally got on the phone, specifically about the payroll protection program, with one of the leading banks, so the biggest banks in the country, and their most senior person, the information that they were sharing with me said, hey, this is what you have to do and the time you got to do it. Well, the problem is none of the other banks complied with that. Right? Everything is moving right now. So I keep telling people it's hour by hour, day by day. Just make sure when you're advising people, when you're talking to people, make sure you do discuss the worst case scenario is, hey, it does impact your credit score. We're being told right now it doesn't, but what if it does? How does that change your decision?
That's great coaching, Tom. Because the person who asked that question might know more than any of us know about it. They've done the research and it was very important to them. And they're saying, no, on my thing, this is what's taking place. But what I'd be a little nervous about, that word absolutely, that word shouldn't exist in anyone's language right now, because things are changing rapidly. And you don't want to tell somebody something and then have to be under the pressure of saying, well, what happens if it changes? I'll tell you, I'm keeping current manners. That's what the name of our company. I am cursed that I name our company that. Because if somebody changes their mind tomorrow, we have to put a whole new stuff out. All right. So just be a little bit careful about that word absolutely. And I'm not questioning that person isn't right. They very well could be right. I don't know that. But the only challenge is, even if they are right, they might not be right a week from now.
Bingo. And that's my point for the listeners. By the way, I want to thank everybody that has been sharing this content, whether you're sharing it with members of the community, or your past clients in Sphere, or on your own personal page, or with your business pages to all of your other real estate professionals. It's so important today to make sure that we get the right information out into people's heads so they can make good decisions. So I want to end with one last question, fellas, and then we'll do a wrap up, because I know you guys have got some other insights you want to share. But a question I got a few times is, hey, so I own rental properties and my renters now are telling me they're not going to pay. What do I do?
I think that's a great question for David.
I think therein lies the challenge. Therein lies the challenge. There is not, to my knowledge, I don't know that there's a solution for that right now.
All right.
Right.
I'll give a little bit deeper. And I was hoping he was going to come up with something miraculous. All right. What winds up taking place is there's so much misinformation, and I can even argue disinformation in the marketplace, that there will be some tenants that think that somehow they were relieved of that obligation. And they might have read that Cheesecake Factory decided they weren't going to pay any of their, landlords and all the shopping centers there are around the country. And I'm going to do the same thing Cheesecake Factory's doing. Mm-hmm. And they're doing it. The challenge that you're going to have is, and I think that David covered this before, they're not going to get evicted right now because there's no judge in the, first of all, there might not be a judge in the courthouse because he's already confined to stay home, or she's confined to stay home. And if there was a judge someplace you can get in touch with, getting an eviction notice right now is going to be really tough. And the tenant would know that. The tenant would understand that. What I think that you have to do is build a relationship, because I own several rental properties myself. They're on the commercial side, but it's not that much different. What they have to understand is if they don't pay the rent, doesn't mean they don't owe you the rent. So it might be better to, be understanding of their situation and say, all right, let's work something out until you're back. And then it's almost like the bank saying, are we going to get, and you could give them three options. Are we going to now take an extra $200 a month? I don't know what the rent is, an extra $200 a month for 6 months after the 4 months you get, free. So we make up for that. You almost have to work like the government's working, saying, what do we need to do right now? The other thing I might do if I was a landlord on residential property, just like I'm doing on the business side. On the business side, I'm working with my tenants to say, all right, what that's there, if you're losing money, I get it. What is involved in the care situation on small business loans? And I'm helping them find that information. All right. And the same thing that could exist with someone in one of your residential rental properties. Maybe it's time to help that person again that time, but maybe a good thing to do would be for both of you would be to help that person realize that they can get some things that they might not realize they could have gotten.
Yeah. David, any closing thoughts on that? Now that Steve shared a few more?
No, I think that perspective is right on. And I think adopting the mentality, all of us saying, how do we come together? And you're seeing so many people come together, but what Steve said is, how do we look at people that we may be landlords for and say, how do we work through this? How do we get through this? Versus looking at it either on the mortgage side or the other side of, hey, let's take advantage of a program that we might not really need. So I think it's got to be individually based and based on need.
I agree. Well, gentlemen, this has been very helpful. And, each week we've been jumping on here and sharing with people. Just kind of closing thoughts or statements between now and next Friday, maybe I'll go with David first. David, sort of closing thoughts for the industry, closing thoughts for consumers that are watching this because their agent shared it with them. Just give us your closing thoughts.
Absolutely. I mean, so at Keeping Current Matters, Steve mentioned on the front end, we are our research and content team is working daily to update things. I mean, forecast and things right now are shifting. One of the things, Tom, that we've done a lot together is talk about GDP and this talk about recession. And while we see that forecasted in normal markets quarterly or annually, we're seeing that revised right now at the week basis. And so I think next week being able to talk about what is the latest, what are experts saying, the question on everybody's mind right now, and one that we're working hard to bring research to, is what impact right now is unemployment going to have, not only on the housing industry, but in our world, and starting to take a look at that. We know that the last 2 weeks we've seen massive shoot up in unemployment. And so those are some of the things that we're looking at right now. And I think we'll have a really good handle on next week to be able to give some perspective on that, and really some of what the experts are saying. This is what we're going to see.
And I like what David's saying, because I'm going to just jump right on back of that. 10 million people got laid off had jobless claims in the last 2 weeks. 10 million people. All right. If you haven't seen that graph, we'll bring it to you next Friday, because when you see it, it's like, wow, compared to his historical averages. All right. And today we got almost a little bit of false news. Well, the unemployment rate is only 4.4. That doesn't really sound that bad. The only thing is they do the survey on March 12th. So the 4.4 was from, the middle of February to the middle of March. That was really the time they were talking about. The next one's going to be, if I had to pick a word, horrific. Yeah. Now we're doing that because obviously it is a horrible time for anyone who's losing their job. I'm not saying that, but we're doing the research to say, well, what impact is that actually going to have on housing? And I will tell you this. We needed two things in order to do that. What are the projections? What are the experts projecting unemployment to be over the next several quarters? And the second thing we needed to do is do the research on, and historically, if an interest rate goes up, if unemployment rate goes up, do sales actually go down and vice versa? And this is what I'll tell you. On the first piece, what the projections are, they're looking a little bit tough. On the second piece, you know what? There is no symbiotic relationship, and I'd love to share that with you people next week.
Excellent. Well, I appreciate it. So again, for all my friends out there, thank you for sharing this information, for getting in front of as many people as possible. Remember now more than ever, what's going on up here really matters, right? Try and stay out of that right side of your brain where fear and anxiety and stress lives, unless you're experiencing the joy and the happiness, because that's there as well. Let's make sure we keep it on the left side with the data, with the facts. So we're making good decisions, not just for ourselves and our family and our closest friends, but also for our customers, right? Now more than ever, we need to be the trusted advisors in our communities and bring them good information, the facts and the data. So, all right, gentlemen, I appreciate you so much. I know I'll talk to you a bunch between now and next Friday. For everybody else, absolutely. Safety first, keep your business moving forward. And remember always, right? Make sure you're doing the things that keep your business alive to support customers. We'll see you guys soon. Take care.
Bye-bye, guys.
Take care.